Well, this week in Spain, it's Brett Hanson is back. How are you doing, Brett?
I'm good, thanks, Howard. Very good, actually. What about yourself? How's everything going?
I'm very well, thank you very much.
Good.
Well, January seems to go on forever, but then February flies by, and we're now fast approaching the start of the new UK tax year on the 6th of April. So, over this week and next, Brett will take us through the tax changes coming our way, which can impact British expatriates in Spain too. Today we'll cover inheritance tax and domicile, and next week pensions. So Brett, what is the UK inheritance tax, and were there any changes made to it for the next UK tax year?
So, UK inheritance tax, Howard, is payable at 40% on the worldwide assets of somebody who has died as a UK domicile. If someone is a non-UK domicile at the date of death, then UK inheritance tax is only paid on their UK situated assets. There is a £325,000 threshold, and so tax will only apply if the estate is valued above this figure and is only charged on the difference. For example, Howard, on an estate worth, say, £425,000, the tax would only apply to the additional £100,000 above the £325,000 threshold, which at 40% would mean a tax liability of £40,000. In addition to there being no UK inheritance tax on any estate that is valued at less than £325,000, there is also no inheritance tax if someone leaves their estate to their husband, wife or civil partner. And if the person who dies leaves their home to their children or grandchildren, the threshold increases up to £500,000 if the deceased's estate is worth less than £1 million. And as married or civil partners can transfer assets free of tax between each other, one partner automatically inherits the other, and as married or civil partners can transfer assets free of tax between each other, one partner automatically inherits the other's unused allowance. So the estate of someone who can use their late partner's allowance and leaves a home to their children or grandchildren will not be liable for UK inheritance tax on anything under £1 million, provided their estate is below £2 million. With regards to the reforms announced to UK inheritance tax for this coming UK tax year, in the autumn budget, Chancellor Rachel Reeves declared an extension to the freeze on the inheritance tax thresholds for a further 2 years. So, Howard, these have all been extended now to 2030. Other than these extensions to the freezes on the allowances, there were no other major changes for the next year, though there were changes to domicile, which I'm sure we'll be covering shortly. Whilst how these freezes on the allowances don't seem much, I think it's worth pointing out that UK inheritance tax raises quite a significant amount of money, around £8 billion last year, and this is actually expected to increase to more than £14 billion over the next 5 years or so as more estates increase in value whilst these allowances continue to stay as they are.
What about in future years? Are more reforms planned?
Well, Howard, there were 3 announcements made in the same budget which will impact UK inheritance tax in future years. 2 will come into force from the 6th of April 2026, and the third will apply from the 6th of April 2027. The first is the agricultural relief and business property relief, which received significant media coverage towards the end of last year regarding the impact this will have on farmers. Basically, from the 6th of April 2026, for such assets including farmland over £1 million, there will be an inheritance tax rate of 20% applied when the owner dies and these assets pass on to children or other beneficiaries. The second, Howard, related to qualifying alternative investment markets, or AIM, shares, which currently enjoys a full exemption from inheritance tax if you have owned them for 2 years or more. Again, from April 2026, they will be subject to UK inheritance tax at a reduced rate of 20%. But for me, probably the reform which is likely to impact more listeners will apply from the 6th of April 2027, and this is that inherited pensions will be subject to UK inheritance tax. This is significant, Howard, because pension funds are normally excluded from UK inheritance tax, but from April 2027, inherited pensions will be liable to UK inheritance tax. And not only will these UK pensions be included within the value of a person's estate for UK inheritance tax, but when the beneficiaries then start drawing down an income from them, they will also be liable to income tax on any income taken. So for a UK beneficiary, they'll potentially see 40% UK inheritance tax paid on the pension fund, and then up to 45% tax on any income taken from the remainder of the pension. At the same time, more people invariably lose part or all of the main home allowance if their pensions, when added to all other assets they own, tip their estates over the 1 million mark.
That's not good news. Let's look at a domicile, since this determines whether or not a British expatriate are liable to UK inheritance tax. What have the rules been so far, and how does it all change from April?
So, inheritance tax, Howard, is determined by someone's domicile status rather than their tax residency. And this is important because for many British expatriates living outside of the UK, under the current rules, they remain liable to UK inheritance tax on their worldwide assets for as long as they are domiciled or deemed domiciled in the UK, even if they have been resident of another country for many years. And whilst residency is easy to define and prove, domicile is a completely different matter, and historically it was based more on circumstances and intentions. But Howard, this is all going to change very soon. In fact, from the 6th of April of this year, when the domicile regime will be replaced by a system based on long-term residence, where someone will not be regarded as a UK domicile once they have been resident in another country for 10 years. So for anyone leaving or have already left the UK, they will remain liable for inheritance tax on non-UK assets until they have been resident in another country for up to 10 years, depending on how long they've lived in the UK before departing it. For most UK nationals retiring abroad, they will need to do the full 10 years being resident somewhere else other than the UK to become a non-UK domicile. And for those who are considering or are already in the process of moving back to the UK, if you have done 10 years residency elsewhere, then you can go back to live in the UK for up to 10 years and still remain a non-UK domicile. With this clarity, Howard, there's no doubt that things can be done to minimise the impact of UK inheritance tax for UK nationals who are leaving the UK or already living abroad, and for those who are returning to live in the UK but have done or will have done 10 years outside of the UK before moving back.
So this seems some good news. What advice do you have for listeners regarding their estate planning now?
Well, Howard, with change often comes opportunity, and now the rules around domicile and UK inheritance tax are clearer. There is no doubt that with some careful planning there are strategies which can be put into place to minimise UK inheritance tax, especially for those looking to move to or already living in Spain. And at the same time, there are also opportunities for those who have been living in Spain for 10 or more years and are thinking of returning to the UK to live. So, whilst there's no doubt UK inheritance tax is going to impact more and more people over the coming years, what with the thresholds for when the tax becomes payable continue to be frozen, and the fact that assets that were once not liable to UK inheritance tax will now be, there are opportunities for those moving abroad or returning to live in the UK to legitimately minimise or avoid paying tax. And if any listeners are concerned about UK inheritance tax, Howard, then it's definitely worth contacting their local Blevins Franks office in order to discuss this matter and to establish what steps can be taken to minimise or completely negate this tax. If any of our listeners already have an estate plan in place, they may need to revise it following the budget. And so again, perhaps this is a good time to contact Blevins Franks.
Before you go, Brett, last week Cahal mentioned you've got some seminars coming up shortly in Denyer. Can you give us some more information, and how can people book?
Yes, I'm holding a seminar, in fact, on the 10th of March in Denyer, where I'll be covering UK inheritance tax and domicile, changes to UK pensions and GUROPS, which is a subject I believe we'll be covering next week, Howard, the end of Spain's golden visa, and this potential high property tax on non-EU buyers that we've been hearing about. For anyone interested in attending, you can find details on our website, and from there you can also reserve a place. I also understand that there are going to be seminars coming up in Murcia, Majaca, Mallorca and Malaga later in April and early May. And details of those will also be appearing on our website. And our website is blevinsfranks.com.
Many thanks, Brett. As they say in politics, a week is a short time.
They do. Thanks, Howard. Speak to you in a week.